welcome to Sectors Up Close. I'm Elena Casas. Today we're talking UK equities and my guest is Chris Beauchamp, Chief Market Analyst at IG. Last Friday, the new British Finance Minister Kwasi Kwarteng announced a surprise tax package, scrapping the top rate of income tax and cutting the basic rate, national insurance and stamp duty in a bundle costing the Treasury an estimated £45 billion a year. That's on top of an energy price guarantee that will cost £60 billion over the next 6 months, pushing the British government's borrowing to £190 billion this year. That had an immediate impact on the cost of that borrowing. This is the yield on 10-year gilts over the last week. That rate spiked at 4.5% on Tuesday after a strongly worded rebuke from the IMF, saying large and untargeted fiscal packages are not recommended in this period of high inflation. The pound fell to historic lows on Monday of just $1.03 as currency markets lost faith in the British government's economic management. Well, the Bank of England launched an emergency intervention on Wednesday morning. It has started temporary purchases of up to £5 billion in long-dated UK government bonds a day, saying it needs to restore orderly market conditions. That calmed the gilt markets somewhat, but has failed to really stabilise the currency. So, where does this leave UK equities? Let's ask Chris Beauchamp, Chief Market Analyst at IG. Chris, good morning. Thanks for joining us. What then do you make of the Bank of England's intervention yesterday? How much difference does it make, and can the bank stave off a worse crisis?
It's staved off a crisis for now. I think we were looking at, and the more we hear about this, the worse it gets, really. We were looking at quite a bit of a crisis in terms of pension funds and their liabilities, given the way they were having to sell gilts to meet what looks like margin calls due to the way they were structured. So while this looks like a return to QE of the old style, in actual fact, it's far more of an emergency sort of market operation designed to stabilise the situation for pension funds rather than to help the government borrowing. That appears to be sort of the incidental element. I think it doesn't really calm anything in anything but the shortest of timeframes. We still have, as you highlighted, a huge amount of borrowing expected from the government. That borrowing is supposed to get more and more expensive, and really leaves all these questions unanswered. And that's why I think you've got this negative reaction across global markets this morning, but particularly for UK shares.
What does it mean then for the FTSE 100? You might expect foreign investors to start jumping into it, given that everything priced in sterling now seems to be on sale. But we're not really seeing that, are we?
No, not at all. I think that there's a huge amount of uncertainty in the comments from the likes of the IMF and then hints from other World Bank members over the past 24 hours saying really that investors aren't looking for the kind of things the UK government is offering. And whilst that does mean that the market moves do mean that the FTSE 100 is essentially on sale, if you like, fire sale, really, at this point in time, given the drop in the pound. There's a lot of uncertainty. Do you want to be putting your money to work in an economy like the UK, which is facing this kind of uncertainty in terms of higher borrowing costs, in terms of weak economic growth, in terms of hitting consumer spending? And one that, of course, is still in the process of a messy divorce, let's put it that way, from its largest trading partner. Without Brexit, this might be a very different situation, but it just complicates things in a whole host of ways. So while we talk about the FTSE 100 as being not really a UK index, of course, it's full of international companies. It is the fact that, of course, they're all listed here, and we're seeing as well the 250 down even more. But there's just that great uncertainty. People don't want to be putting their money into an economy which faces such a dangerous cocktail of problems.
What needs to happen then for international markets to regain confidence in British stocks? Is it possible at the moment?
It's going to be very hard because I suppose if you immediately do a U-turn on policy, that sends a message that you simply don't know what happens next. Now, the government did try the whole submarine approach in terms of not saying anything and just pushing on with the policy, but I'm not sure you can get on with that in a world of 24-hour news and 24-hour markets. So far, the broadcast around this morning of the Prime Minister has not gone particularly well. It is for local news, but I think it underscores the problems the country is facing. And I think we're just wanting to see some kind of better budgetary outlook. Now, we're not expecting a budget till the end of November there, from an official budget, if you like, or financial statement from the Chancellor. And so that gives us weeks and weeks of uncertainty. And markets simply don't have the time for that, really. So I think what we'd want to see is an unwinding of a lot of those policy measures, especially those cuts to the top rate of tax, if only because it's a symbolic element to show that it's concerned about the fiscal outlook. And unwinding the entire budget is certainly almost impossible, I think, but a recognition that they will need to temper these fiscal measures until the outlook becomes clearer.
Would you advise investors to keep money in sterling at this point?
It's a very tough one. I think if you've prepared to stick with the volatility and you're prepared to look at the longer term, then maybe we have a future for the UK economy that is better than people think. It could be a gamble that pays off in the long term. But I think in the short term, you're just going to have to sit with these stomach-turning levels of volatility that would just be unnecessary. I think for a lot of investors will be saying, well, surely there are better places to be. And I think it just boils down to each individual person to say, well, where is my money best served? By being in the UK, which is an uncertain economic outlook, or in other places, I think. And that's the question that everyone really has to ask themselves at this point.
Well, thanks so much for that insight, Chris Beauchamp, Chief Market Analyst at IG. That's your roundup of UK equities. I'm Elena Casas, and this is Reuters.